Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of LME 3-month lead and tin. I'll start with LME 3-month lead. Okay, so looking back at the recent bearish action, we can see it all started from the failed follow-through higher to both the weekly key reversal up in mid-April and a daily key reversal up on the 19th of April, which also turned out to be an indecisive doji cross right at the top of the recent market. Things then became interesting as we could look at the whole action from the heights of March all the way down until 2 weeks ago. It's a large bearish halfway hesitation for potential target X in the 2030 area. This was actually one of the most gratifying moments in recent times as prices dropped down to reach target X and immediately shot back up. The subsequent rise, including the fall and resurgence last week, pushed up through now. These are in no particular order. There's the congestion at 21.32 to 35, the extension of the lower trend line for the May to June 21 descending triangle, currently at 21.46, and interestingly the middle time, currently 20.51, of the March to April bearish Andrews pitchfork. What was especially interesting about this middle time last week was how the tail on the bullish harami last Thursday dropped down to the middle time, seemingly to gather ammunition, and prices shot straight up thereafter. Recently, there's been a lot of this shooting up straight thereafter, after reaching targets. Anyway, in addition to this large bearish halfway hesitation, the action from that same peak on the 19th of April also created a small bearish halfway hesitation with potential target X1 in the 2087 area. Unsurprisingly, this was reached 3 weeks ago. So where does that leave us now? Well, prices have risen up once again to the congestion at 21.86, which is synonymous to lows of February and December last year. There is opportunity to move higher still, but there also does not seem to be any impetus to do so anytime soon. At the same time, the violent drop and move back up last week with a low that is significantly higher than the one 2 weeks ago indicates again that the way lower may not be ideal either. I'll add now one key pattern that is still working and two separate and somewhat lagging indicators. The key pattern is the March to April bearish shift pitchfork. The market is right now in between the upper time above, currently at 22.67, and the middle time below, currently 20.51. The lagging indicators are A, the dead cross of the short medium moving average, currently at 22.275, dropping down through the slowly declining medium moving average, and that's currently at 22.99. I'd actually say that the short medium was at 22.75 as well. And the second lagging one is the short medium dropping down through the long moving average, currently 22.88. So whilst we're waiting for the market to decide whether to go up, down or sideways, I'd like to nurture an idea I planted in your mind last week. It is to regard the whole action of 2022 so far, even perhaps going back to November of last year, as a possible diamond pattern. This idea is still way too early, but you may hear more on this should it develop in the future. LME 3-month tin. The move down below the long moving average, currently 39.080, on Monday 3 weeks ago with a bearish opening long black Mariposa, was the market finally making its mind up what to do and choosing the bearish incentive after faffing around for the prior 2 weeks of relative indecision. The drop that day only halted at the 50% Fibonacci, the March 21 to March 22 move at 36.945. However, it carried on lower the next day, though Wednesday of that week saw a temporary respite with a combined immediate countering bullish harami and bullish closing white Mariposa. Yet that did not last, as the next day, that Thursday, saw an even bigger move lower for bearish opening long black Mariposa that dropped down into two congestion zones. The first and smaller one, between 33.665 and 33.475, contained the old April 2011 previous all-time high. The second larger congestion zone is between 31.845 and 32.985 and contains the 50% Fibonacci of the March 20 to March 22 move at 31.845. The first zone slowed the drop whilst the second zone finally halted the fall. and both have been acting as active supports even ever since. What has been interesting about the first zone was how it manages to hold up the market on a closing basis, even if it is a smaller of the two zones. Anyway, the drop fulfilled the downside target, unlabeled it was so close, of the mid-April to date bearish halfway hesitation. So what else has been going on here? Well, I did mention 2 weeks ago one other pattern that was in construction. It was an inverted cup with handle pattern for the March to start of May action. Previously, I'd pointed out that I still found it a bit early for this pattern's development. I'd delved further into this pattern, last week. Well, last week came and part of me wishes I had laid out the parameters for an inverted cup with handle pattern earlier. You see, the market's drop has already fulfilled any potential targets on the downside. What this also meant, as I said 2 weeks ago and repeated last week, is that all the patterns for the downside are for the moment fulfilled. So where does that leave us now? Well, it very much depends on the state of the two congestion zones below. Smaller, 33,665 to 33,475, and the larger, between 31,845 and 32,985. Last week I said, and I quote, if these hold up, then a gradual move over to testing the March to date downtrend, and that's currently at 37,260, sometime in June might be possible. However, I would like to again emphasize the one admittedly lagging indicator that should be borne in mind when considering this. It is a dead cross of the short medium moving average, currently 39,780, down through the falling medium moving average, currently 41,455. Whilst this may not be the cause of the fresh fall in the market, due as I've indicated, likely quality of support that is underneath current levels, it nevertheless seems likely to stymie any potential pullback. And that's the end of the quote. Thus, from this we can infer, as I've already done these past 2 weeks, that we may well go sideways, as we also have roughly done so for the last 3 weeks. And likely for a bit longer, or at least until we approach the previously mentioned downtrend. There's one final feature I'd like to highlight. It is the rising lows seen over the last 3 weeks. Now, we may well be going sideways, but rising lows are usually an indicator of potential for higher markets. I just wanted you to know that. We shall see how all this develops until a better pattern emerges. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Invest Services International Limited. And here comes the final bit.